Following a global survey of over 300 financial institutions last year, 54% of our respondents said that pKYC was a top initiative that they wanted to roll out. Europe and APAC said it was their number one priority, and the US and North America came out as number 3. So why is pKYC important, and what are we seeing in the marketplace? This is Nick Parfitt, and this is your weekly financial crime news wrap-up. So from an organizational perspective, know your customer processes are expensive, laggy in time, and they don't really capture a real-time snapshot of the person's or the entity's ongoing risk profile. Typically, if you're a retail customer, you have a risk score being high, medium, or low. What that means is if you're a high-risk customer, so you may be a politically exposed person, you may reside in a jurisdiction or country that's of high risk, means that we have to look at your KYC file on an annual basis. So every year, that KYC file needs to be reviewed by somebody. If you're medium risk, that's probably 3 years. And for low risk, that could be 5 years, or it may not be at all. But you have to schedule all of these KYC refresh cycles within the operations department. It's a big overhead for the organization in terms of number of analysts doing and reviewing these processes. And because it's not really being looked at within a year period, that customer's profile may have changed a lot during that time. It's different as well depending on the customer segment that you're looking at. Retail customers typically carry a lower risk. High net worth individuals, small to medium businesses or sole traders, or even small corporates can carry a lot more risk associated with that. But also from a sales perspective, if you're dealing with the customer who's suddenly been bought by a bigger customer or who's moved operations into another country or has acquired a lot of new customers in certain areas, you want to be aware of that so you understand what your customer's doing, and it can be a source of competitive advantage. So a financial institution like a bank has different views on what Perpetual KYC can actually mean to them within the bank itself. From a operations perspective, Perpetual KYC means more efficient processes and generally less overhead because we're not having to have refresh cycles based on the customer's risk profile. So there's a lower overhead in terms of data flow. Now, if you're on the business side of that and you own the customer, what you want to know is if that customer's profile changes. They may be in mergers and acquisitions, so they may acquire another business. They may move operations. They may be acquired by another business. They may introduce new products and services, and they may move into new jurisdictions and territories. All of those could potentially impact the risk rating of the customer. And the sooner you have information around that, from a sales perspective, that could also be a source of competitive information because from a banking perspective, you're there to provide services and facilities. KYC and AML processes and financial crime in general have incurred huge amounts of costs, really since the Patriot Act of 2001. Banks have traditionally been heavily siloed with their data, so single views of customer were not a thing. They had a disparate number of vendors within their environment. None of these systems really talk to each other, and they've made huge strides since then to integrate these systems and importantly as well ensure that the data and quality of data is now at a level where it does support pKYC processes. So I'd love to hear from you. Have you embarked on a pKYC journey? Have you successfully completed one? And I'd love to hear whether or not you've realized benefits both internally as well as meeting your regulatory expectations. Thank you for watching. This has been Nick Parfitt with your FeedTide Financial Crime News Weekly Wrap-Up.